Every single month, the US government releases a number. Just one number. And within seconds, literally seconds, billions of dollars move across global markets. Stocks crash. Currencies spike. Gold jumps. Crypto drops. And most people have absolutely no idea this is even happening. Today I'm going to show you the top 10 economic data releases from the US that shake the entire financial world, and by the end of this video, you'll understand markets better than 90% of people out there. Number 10, durable goods orders. What is it? This report tracks how many orders were placed for goods that are meant to last 3 years or more, things like aircraft, machinery, refrigerators, cars, and military equipment. Why do markets care? If businesses are ordering lots of expensive equipment, it means they're confident in the future. They're expanding. That's bullish for the economy. If orders are dropping, businesses are pulling back. That's a warning sign. Real example, in April 2020, during the COVID lockdowns, durable goods orders collapsed by 16.7% in a single month, one of the worst drops ever recorded. It signaled that the entire manufacturing sector had frozen. Markets tanked alongside it. What to watch? The headline number matters, but smart traders strip out aircraft orders. Boeing orders are huge and distort the data. They look at core durable goods, which excludes transportation. That gives a cleaner picture of business investment. Number 9, Consumer Confidence Index. Published by the Conference Board. What is it? It's basically a mood survey. Every month they ask thousands of Americans, how do you feel about the economy right now? How do you feel about the next 6 months? Why do markets care? Consumer spending makes up roughly 70% of the entire US economy. So if consumers feel good, they spend. If they're scared, they save. This index is like a pulse check on America's wallet. Real example, in June 2022, consumer confidence crashed to 98.7, its lowest level since February 2021. Why? Gas prices were through the roof, inflation was surging, and people were terrified. The stock market responded badly, with the S&P 500 falling into bear market territory that same month. What to watch? A reading above 100 is generally healthy. Below 80 is a serious warning. Watch for sharp month-to-month drops, those spook markets fast. Number 8, retail sales. Published monthly by the US Census Bureau. What is it? This tracks the total dollar amount of sales at retail stores across America, everything from gas stations and grocery stores to car dealerships and online shopping. Why do markets care? Again, 70% of the US economy is consumer spending. Retail sales is real data showing whether people are actually opening their wallets or not. It's not a survey or a prediction, it's cold, hard receipts. Real example, in March 2021, the US government sent out $1,400 stimulus checks to millions of Americans. The very next month, retail sales exploded by plus 9.8% in a single month. The market surged. Stocks tied to consumer spending, like Target, Walmart, and Amazon, all jumped. What to watch? The core retail sales number excludes auto sales, because cars are so expensive they skew the data. A strong print above expectations pushes the dollar up and lifts stocks. A weak print does the opposite. Number 7, ISM PMI, Manufacturing and Services. That stands for Institute for Supply Management, Purchasing Managers Index. What is it? This is a survey of purchasing managers, the people who actually buy materials and supplies for big companies. They know before anyone else if business is picking up or slowing down. There are two versions, Manufacturing PMI and Services PMI. Why do markets care? The magic number is 50. Above 50 equals expansion, economy growing. Below 50 equals contraction, economy shrinking. It's one of the earliest signals of where the economy is heading. Real example, in May 2020, the ISM Manufacturing PMI dropped to 43.1, deep in contraction territory. But by November 2020, it had rebounded to 57.5 as factories reopened. Markets followed this almost tick for tick. Investors use PMI as a leading indicator to position themselves before the bigger reports drop. What to watch? Services PMI matters more than manufacturing for the US economy today, because America is primarily a service-based economy. Watch both, but pay extra attention to services. Number 6, JOLTS, Job Openings and Labor Turnover Survey. What is it? Published by the Bureau of Labor Statistics, JOLTS tells us how many job openings exist in the U.S., how many people were hired, and how many people voluntarily quit their jobs. Why do markets care? The number of job openings tells you how tight the labor market is. Lots of openings equals employers are desperate for workers equals they'll pay higher wages equals inflation goes up equals Federal Reserve raises rates equals markets drop. The quit rate is actually fascinating. When lots of people are quitting, it means workers are confident they can find a better job. That signals a strong economy. Real example, in March 2022, JOLTS showed a record-breaking 11.5 million job openings in the U.S. More jobs than unemployed people. This confirmed the labor market was red hot, which gave the Federal Reserve the green light to start aggressively raising interest rates. Markets sold off hard throughout 2022 partly because of this data. What to watch? When job openings start dropping significantly, it's a sign the economy is cooling. That can actually be positive news for markets if inflation is running hot. It means the Fed might slow down rate hikes. Number 5, GDP, Gross Domestic Product. The big one for measuring overall economic health. What is it? GDP is the total value of everything produced in the United States, every product made, every service sold, every dollar of economic activity, measured quarterly. Why do markets care? GDP is the scoreboard of the economy. Strong GDP growth equals healthy economy equals companies making money equals stocks go up. 2 consecutive quarters of negative GDP equals recession, and that word alone can send markets into a panic. Real example, in quarter 1 and quarter 2 of 2022, the US GDP shrank for 2 consecutive quarters, technically a recession by definition. The S&P 500 fell over 20% in that period. Even though the job market was still strong, the negative GDP prints created massive fear and uncertainty in markets worldwide. What to watch? GDP is released 3 times for each quarter: advance, preliminary, and final. The advance release moves markets the most because it's the first look. Anything above 2.5% annual growth is considered solid. Below 1% or negative starts triggering recession fears. Number 4, Core PCE. This one is the Federal Reserve's personal favorite inflation measure. What is it? PCE stands for Personal Consumption Expenditures. It measures the prices Americans pay for goods and services, similar to CPI, but it's calculated differently and covers a broader range of spending. Core means it strips out food and energy prices, which are too volatile. Why do markets care? Because the Fed uses Core PCE as its primary inflation target. Their goal is 2% inflation. When Core PCE is running above 2%, the Fed raises interest rates. Higher rates equals more expensive to borrow equals businesses slow down equals stocks fall. Real example, in February 2022, Core PCE came in at 5.4% year over year, nearly 3 times the Fed's 2% target. This was one of the key data points that forced the Federal Reserve into the most aggressive rate hike cycle in 40 years, raising rates from near zero all the way to over 5%. Global markets took a brutal beating throughout 2022. What to watch? Any Core PCE print that surprises to the upside, higher than expected, sends markets lower, and the dollar higher. A surprise to the downside, lower inflation, is like oxygen to markets, stocks rally, and bonds jump. Number 3, Federal Reserve Interest Rate Decision. Also known as the FOMC decision. What is it? 8 times a year, the Federal Open Market Committee, the Fed, meets to decide whether to raise, lower, or hold interest rates. This single decision affects every loan, every mortgage, every savings account, every stock, and every currency on the planet. Why do markets care? Interest rates are the cost of money. When rates go up, borrowing becomes expensive, companies invest less, consumers spend less, the economy slows. When rates go down, money is cheap, businesses expand, people borrow, markets boom. Real example, the 2022 hike cycle, between March 2022 and July 2023, the Fed raised rates 11 times in a row, from near 0% to 5.25–5.5%. The result? The worst year for stocks and bonds in decades. The S&P 500 lost over 19% in 2022 alone. Another example, COVID emergency cut. On March 15, 2020, the Fed slashed rates to near zero in an emergency Sunday meeting, something almost unheard of. Markets initially panicked, but then staged one of the greatest recoveries in history over the following months. What to watch? The rate decision itself matters, but pay even more attention to Fed Chairman's press conference that follows. His words, his tone, even his body language, can move markets more than the actual decision. Traders hang on every single word. Number 2, NFP, non-farm payrolls. The most anticipated economic report of every single month. What is it? Released on the first Friday of every month by the Bureau of Labor Statistics, NFP tells us how many jobs were added or lost in the U.S. economy, excluding farm workers, hence non-farm. It covers about 80% of all U.S. workers. Why do markets care? Jobs equals income equals spending equals economic growth. A strong jobs report means the economy is healthy. But here's the twist, sometimes good news is bad news. If too many jobs are added, the Fed worries about inflation and raises rates. Markets can actually fall on a very strong jobs report. Real example, the shock miss. In April 2021, economists expected 1 million jobs to be added. The actual number was just 266,000. Markets were stunned. The dollar crashed. It was one of the biggest NFP misses in recent history. Another example, the monster beat. In January 2023, NFP came in at 517,000 jobs, more than double what analysts expected. Instead of celebrating, markets actually sold off, because traders feared the Fed would keep raising rates aggressively to cool the hot job market. Classic, good news is bad news. What to watch? The whisper number, what traders secretly expect, versus the official forecast, wage growth, and average hourly earnings, and the prior month's revision. Sometimes the revision of last month's number moves markets more than the new print. Number 1, CPI, Consumer Price Index. The undisputed king of market-moving data, CPI. The Consumer Price Index. What is it? CPI measures the average change in prices that consumers pay for a basket of goods and services, food, rent, gas, healthcare, clothing, entertainment. It is the most watched inflation gauge in the world. Why do markets care? Inflation is the enemy of markets. When prices rise too fast, the Federal Reserve raises interest rates to cool things down. Higher rates hurt stocks, hurt bonds, hurt real estate, and strengthen the dollar. CPI is the report that tells the Fed whether to hit the brakes or the gas pedal on the economy. Example, the September 2022 shock. On September 13, 2022, CPI came in at 8.3%, just 0.1% above what economists expected. Just 0.1%. The result? The S&P 500 crashed 4.3% in a single day, one of the worst days in years. The Dow Jones fell over 1,200 points, the Nasdaq dropped nearly 5%. All because of one tiny number that came in slightly hotter than expected. Another example, the 2021 surge. In May 2021, CPI hit 5% year over year for the first time since 2008. The Fed initially called it transitory, temporary. By the time inflation hit 9.1% in June 2022, the highest in 40 years, it was clearly not transitory. The Fed had to play catch-up with the most aggressive rate hike cycle in a generation. Markets suffered enormously. What to watch? Core CPI, which strips out food and energy, is what the Fed focuses on. Month-over-month changes matter just as much as year-over-year. And watch the shelter or rent component. It makes up about 1/3 of CPI and tends to move slowly but powerfully. Now, here's the key takeaway. It's not just the number that matters. It's whether the number beats or misses expectations. Markets price in what they expect. Surprise to the upside or downside, that's where the big moves happen. If you found this video valuable, hit that subscribe button because we're going deeper into how you can actually use this data to understand markets better. Drop a comment below, which of these data points surprised you the most? I'll see you in the next one.